Hello, and a very warm welcome to the New Look Macro Mondays. I'm Lisa Aziz, your host, and with me in the studio today are James Brodie and James Todd. Morning, guys.
Morning,
Lisa. Good to see you. Just actually remind our viewers, if you would, a little bit more about what you do and which areas you cover in oils and derivatives.
Thank you. I'm a former trader and now I'm head of learning and development here at Onyx Capital Group.
Brilliant.
And I was on the trading floor at Onyx Commodities and now I'm trader performance manager.
Brilliant. What, though, is exactly Macro Mondays? Well, each week we aim to cut through the noise to bring you the key global macro stories, the trends, charts, risks and trades that matter most. So in the next 30 minutes or so, we're going to be taking a deeper dive into those volatile US equities. Why did those really good NVIDIA earnings end up rattling the markets? Also, weaker UK data. What does that all mean with the budget looming, of course, this Wednesday? Plus, we'll be asking, why are the crypto markets collapsing? And do stay tuned naturally right until the end, when we'll be sharing details with you of our brand new training courses available online and at our London offices alongside our new traders. Right now, though, let's get stuck in. Lots to cover off. Those weakening US economic stats, then, we've seen emerge in recent days. James B., how would you sum up the picture?
As you say, the economic data is weakening. We had September payrolls came out last week. Of course, because of the government shutdown, that's massively old data. Actually, the headline number came out higher than expected, beat the market, but again, old data. Key concerning point, though, is the unemployment rate ticked up, as you can see from the chart here. And actually, you go through economic cycles, you can see it's a weakening economic cycle in the US. Also, more timely data we had last week, the weekly jobless claims, that came out higher than expected. Again, that's bad news. 232,000 jobs were lost last week, expected to be 223. So that's...
Yeah, I mean, I think as well, one of the things to emphasize is ultimately a lot of this data, it was retroactive and not high quality data. But I think this unemployment figure is something that people are really looking towards. And whilst the September figures are slightly unclear, people are looking forward to the October and November data and not looking upon this favorably, worrying that unemployment's going to be higher. And of course, that's going to have to be impacted and be met with government response.
Well, indeed. And of course, it will rattle Trump, won't it, in his administration, trying to deliver a completely different narrative to the US citizen, i.e. that they're going to deliver better days ahead for them.
Yeah, but the big problem for the Fed is the data comes out after the next Fed meeting. So the Fed are meeting on the 10th of December, but the data comes out the following week. And if I move on to the next chart, you can see what's concerning for the Fed. Well, unemployment's going up, inflation's going up as well. So unemployment going up, the market says they should cut. Inflation going up, of course, they need to be on hold or even hiking rates. So CPI was at 2.2 in April. It's now at 3%, being driven by the tariffs, but it's clearly moving in the wrong direction.
A bit closer to home then, UK data, of course, we've seen that weaken, haven't we, ahead of what is clearly a huge week for the Chancellor and her budget statement on Wednesday.
One chart quickly before that, though, is we look at US consumer confidence from the University of Michigan. We're going back all the way to 1990. It's only been lower during the peak of inflation in June 22. The US consumer is hurting badly. Unemployment's going up, inflation's going up. So Trump's, his ratings getting hit pretty badly here.
They absolutely are, yeah.
And my big concern is as AI comes in, certain jobs, low-income jobs are being replaced as well. So Trump, he needs a quick win, and I think he's turning to Ukraine for that.
Yeah, the narrative is very much that, if you look at headlines about sort of Amazon cutting jobs, etc., AI is supposedly the leading cause of this. And that's not even necessarily because of AI being used to replace bureaucratic jobs, but it's also the amount of money that is having to be spent on AI by companies like Microsoft. So Amazon Web Services was basically, that was their high margin part of the business, and sort of retail shopping and shipping was low margin. To see their expenditure rally on such high prices for chips and AI software has meant that they're having to cut jobs. So I think a lot of people are looking at this as really, really worrying that not only are we going to see unemployment probably rise in the future as bureaucratic jobs are replaced by automation, but also the expense on this automation is going to be increasing. So it's very worrying for sure for investors and also for consumers.
I agree with you on the investment costs for these tech companies, but other companies actually earnings are going up because actually they've got a lot of costs being reduced. So I think that's one of the reasons why we're seeing the S&P 500 is holding up, whereas you're seeing the AI stocks are being hit lower.
Right, let's now tackle some of that UK data a bit closer to home.
Yeah, if we move on to the UK, we've pretty poor data last week. Retail sales expected to be flat month on month, fell 1.1%. Expected year on year to be up 1.5%, came in just up 0.2%. So consumer here's not spending either. UK government current budget deficit also is tracking to be 15 billion more than projected. And also we had some flash PMIs last week. You can see from the chart here, and the employment component is falling, which you see correlates very highly, of course, with payroll employment. So UK data is pretty weak, and we have the budget looming this week.
Yeah, absolutely. I don't think it's catching anyone particularly by surprise, though, as well. This any surprises in the data would have been to the upside, and particularly as you're coming in towards, what is a strong season for retail typically in terms of consumption. To see declining data, it's emblematic of wider problems in the UK.
How do you think the sentiment will be inside number 11?
Going to be pretty worrying. The Chancellor's deliberately pushed the budget back to the end of the year to try and hope the economy will be in a better place. It's not, it's in a worse place. They've thrown so many possible implications of what they may do. It sort of covers to mask, what may have come out, but I think it's going to be pretty concerning what comes out on Wednesday.
Markets must be on tenterhooks, right?
Absolutely. And when you're seeing, obviously there's going to be a large impact on the gilt market first and foremost. We'll also come to talk about cable, but ultimately Reeves is going to be in a very tough position. She's going to be stuck between a rock and a hard place. And, to my mind, it's essentially an impossible decision. The tools available to her are very blunt. I think, as you say, she was probably hoping for an uptick that was, out of her control and she could point to things and not have to be severe. But it looks as though she's going to have to be quite drastic. And that's going to be worrying for the gilt market, worrying for the UK economy, and also worrying for her, position at number 11 ultimately.
Oh, quite.
But we need something fairly draconian, as we've seen in Argentina or in Italy, but the Labour Party don't want to cut the welfare state, and it looks like that may even grow this Wednesday. And we've seen now companies saying they don't want to invest in the UK. Over the weekend, we've seen another Lakshmi Mittal, the 7th richest man in the country, has decided to leave because of tax.
That's an interesting move, because of tax.
Yeah, so it's not good. And if we look at the charts, cable, if we bring that up, so this is the pound against the US dollar, you can see the pound is going down. It's sort of, there's a key support line. It's 131.85. It broke below there. What was the support comes resistance, and now it's starting to fall again. So again, this is the pound, one of the weaker G10 currencies. Only the yen is weaker at the moment. But again, there'll be a big focus on the budget, and again, will it be another Liz Truss moment?
I would expect this trend over the longer run as well to be significantly down. Not just talking about for the next sort of 3 to 6 months, but longer than that. And if you look at the number of companies IPOing on the London Stock Exchange, we are at pretty much all-time lows, lows for the modern economic period, ultimately, since about 1990. That reflects investor sentiment and business sentiment in the UK being very, very weak.
Right, let's hop back across the pond, go back to the States. Just take us through, if you would, the volatility that's faced US equities of late and the key drivers.
Yeah, we had a big week this week with the NVIDIA earnings. So that came out, that beat expectations. We'll come out with the NVIDIA chart in a second. But we saw an aggressive sell-off that day. Actually, the earnings came out overnight. The following day, the market opened significantly higher and then ended up closing lower. So we saw S&P, there's a key support level here at 6,550. The market closed kind of right on that on Friday. Well, actually, it bounced on Friday because the market's now expecting a Fed cut. But it's an absolute key level. If the market closes below there, we'll see stops triggered and we'll have seen a top of the cycle in S&P. So the market's hoping for the Fed to cut. And if we move on to the NVIDIA chart, see, NVIDIA earnings came out, revenue 57 billion, that's up 22% quarter on quarter.
Just explain that to us, because it surpassed expectations.
Absolutely.
So
but
everything went up and then but straight down again.
Yep, the market on NVIDIA opened, you can see here, opened up 6%, but then immediately got sold into. Says concerns around the AI, the amount of debt that's being taken. And the market opened, as I say, up 6%, finished down 3%. There's a key support here, right on it, $180. Again, if we close below that, we'll see more stops get triggered. We'll see more selling. Again, there's huge leverage positions in these AI stocks.
My take on this is that this is a really significant moment. Ultimately, we saw a mass liquidation event across multiple asset classes on no significant headlines, if anything, or no bearish headlines.
On good news, yeah.
Exactly. And so to see such a liquidation event, I think you can really infer a lot from this. And the inference is that this is the likelihood, the balanced probability is that this is a bubble, and I want to take profit on this before the bubble bursts, ultimately. That's what I think a lot of investors are saying, a lot of traders are saying. I think we could be at the top of a really sharp decline here.
Yeah, and if the market can't go up on good news, then it's going to take something pretty substantial to get new all-time highs.
For sure. Just remind us then to... Oh, no, you want to take us to the Oracle chart?
Again,
let's go through this.
We discussed this last week. Yeah. This is Oracle. This is a credit default swap. So back in, I think it's September, Oracle briefly had the biggest market cap of any company in the world, based on their build out into these AI, the power, the data centers. But you can see the market suddenly getting pretty nervous. Oracle's fallen over 40%, I believe. Credit default swaps are going up. So the market's saying, yeah, is there a chance they actually default on their debt? But here you can see it's overlaid with the investment grade credit spread. So this is the difference between the investment grade credit, the bonds, the bond yields of the top companies, the spread between that and US government debt, which is seen as risk-free debt. And you can see those spreads aren't widening out yet. So the market's kind of saying this volatility is specific to AI. And in fact, if you look at the interesting point with it as well, a lot of the debt potentially for these AI stocks is actually going to come from the likes of Microsoft and Apple, who are AAA rated. So that may be a saving grace, but just the huge amounts of debt being talked about, that's why we're getting these concerns in the market. Also, fund managers. So Bank of America Global Fund Manager Survey. Here, for the first time ever, the majority, record number of investors say companies are overspending. So again, this overspending and concern about debt, it's gone positive for the first time ever, and that's all based around AI.
Yeah, I would flag that on this overinvesting issue. Ultimately, there will be a political side to the answers of a lot of these fund managers as well. Because if you are investing in something that your country doesn't have a comparative advantage in, you would look to that and say, that's probably a misallocation of resources, that's overinvesting. And ultimately, though, it really is a comment on how much debt a lot of these private companies are accumulating, and people saying, this is perhaps coming towards like a bit of a terminal rate.
There was also a lot of chatter here, when the NVIDIA earnings came out, and talking about, the ambition is for so many big data centers, so many hubs. I think there's going to be a couple announced just this week in Wales, for example. But there's a lot of chatter about, where are we going to get all the power to power these massive sites? Because apparently at the moment it's single digit, level of being able to power these centers, the energy that will be needed.
Absolutely. We mentioned this last week. NVIDIA in its hometown has built 2 data centers, and they're not running at the moment because they don't have the power to run them. So the question has moved on, not so much to AI, but what's going to power AI.
It's also getting more power isn't an overnight issue. You can't just, magic it out of nowhere. So it takes a lot of investment going forward. Whether people do invest ultimately depends on whether they see the power demand from, data centers as being a reliable long-term demand pool. Because if it turns out that all AI is a bubble, there's going to be no demand for it in 5 years' time, and you are a significant power generator in the UK, and you've suddenly invested a huge amount for what could ultimately be lackluster demand in 5 years, you're not going to have a very happy board of directors to answer to. So.
And China's a country that's on top of this. Yeah, China every 18 months adds more power than the US has in total. If this becomes an arms race, who can come up with the best AI, then that's a comparative advantage that China definitely has.
Meanwhile, everybody's terrified they're going to lose their jobs through AI, but not necessarily overnight by the sounds of it.
No, and ultimately, a lot of these people have a huge amount of uncertainty, and people on social media are quite easy to whip up into a hysteria these days. So, I would say keep calm and carry on for now.
Love it.
And again, the S&P chart that we looked at, the S&P, despite all this volatility last week, is just over 5% off its all-time highs. So,
in the great scheme of things. Yeah.
And in the great scheme of things, it's not a particularly big move. But one other chart that's interesting is this one. Private equity stocks are rolling over here. So this is the S&P listed private equity index. And of course, these are sort of leaders, forefronts in company development. But you can see here, tight correlation with the S&P 500. And clearly, they're currently moving in opposite directions.
Let's move on. Just remind us, we've touched on it earlier, but the latest sentiment, say, surrounding any possible rate cut decision by the US Fed, as you said, James, 10th of December.
Yep, Friday morning, as we said, equities looked like they were going to break aggressively lower, but suddenly bounced when we had more dovish Fed speak. And now the market's pricing from 30% to 77% chance that the Fed cut on December 10th. So the market's now expecting a cut, which supports equity market. If you look here again, this is the 2-year yield. You can see there's a clear support there around the 340 level, clear resistance above. The OIS is pricing 88 cuts in the US over the next 12 months. So the market's saying the Fed are going to keep cutting. And what we'd need for that to break lower actually would be weak payrolls. Even if the Fed come out dovishly and they do cut, there's already 88 basis points of cuts priced. But that will be the payrolls that come out later in December, just after the Fed meeting. If that's really weak, then the market will start to panic. Yields will break lower and the market will price more aggressive cuts.
On to currencies. How are those markets looking?
Yep, we discussed the pound as weakening against the dollar. Moving on to the dollar chart, you can see the dollar index here. And 6 months ago, it's all about dollar weakness. But I think it's part of its US exceptionalism. The economy is resilient. We have these tech companies, earnings are still strong, and the dollar's bouncing. So this is the trade-weighted index, dollar index, which is 55% of that is a dollar against the euro. But the dollar's clearly bouncing. There's a key level here you can see at exactly 100. And markets like technical levels, round numbers, but you can see a break above that, and then the dollar strength will continue. Particularly strong against the yen at the moment. Of course, the yen has their debt concerns, but clearly it's strengthening against the pound. It's strengthening against other currencies like the euro, Aussie, Kiwi. New Zealand's expected to cut this week, but we're seeing dollar strength.
Brilliant. What about commodities? Similar picture there or not?
Yep. And if we look at gold, favorite chart at the moment, or favorite commodity, I should say, of the markets, you see we had this huge rally, sort of 4-month rally, pulled back, bounced again. You can see we're sitting on a key support line here.
My take on gold is that ultimately the liquidation event that we saw last week on the post NVIDIA earnings, this managed to affect a huge number of asset classes, and the fact that it didn't affect gold that much is, for me, that's a telltale sign that gold is supported here. So I would be surprised if we were to break down below that sort of $4,000 per ounce level. It's probably going to be a bit of a range-bound asset class for now. I would be surprised if it were to break above 4,400 without significant news or something ultimately changing in the wider ecosystem that meant that gold was, incredibly sought after. If you were to see, worrying signs, perhaps if the dollar were to break lower, that might be your impetus to see a breakout to the upside, but that would only happen if we were loitering around the sort of key support, the key ceiling. But yeah, so I think the fact that gold has maintained some momentum here is a bullish sign ultimately.
Yeah, I think an interesting point with gold as well is Thursday, Friday, when equities got hit hard, you'd expect it to bounce, but it didn't. I think part of that is because hedge funds were liquidating positions across the board. So they'd be unwinding, while they're unwinding potential losses in equities, they're unwinding profits elsewhere. But I agree, over time, I'd expect gold to continue going higher. We've mentioned for months now, we have the central banks rotating into gold as well. So we definitely know there's a bid under that market. If we look at uranium, despite the long-term needs for uranium and for power demand, you can see that's falling aggressively. I think this just ties in with the whole AI and power story. There's concerns there around the AI stocks.
I would have thought you'd see a good correlation between uranium demand and ultimately price action and AI stocks overall, probably for the next 18 months or so, as uranium is probably one of the fastest growing power supplies going forward.
Absolutely. And the one commodity that held up actually last week was copper. So that's onto the next chart. Copper, you can see here, it's going sideways. Well, the others have been hit. Uranium has been hit hard. Gold's had lots of volatility. So I think, again, we know copper, there's a long-term supply shortage.
So we spoke last week, didn't we, about actual grades of copper. People were concerned about the quality that they could get their hands on.
And also the amount that there is in supply and how long it takes to get these mines on board. You can see if copper's not selling off while other commodities are, then again, that means there's an underlying relative strength in there.
Right, should we talk about that crypto crash still
Brent,
ongoing?
actually, let's go to Brent. Let's look at Brent. We have a chart here, correlation with the 10-year yield.
Yeah, I mean, the sort of headline in Brent is ultimately nothing that much fundamentally seems to have changed. We still see, margins being very high for refined products, which should be providing support for the outright Brent price. But we saw that liquidation event last week, Wednesday, Thursday, being passed through into Brent as well, and we saw flat price come off about $2 a barrel. So yeah, it's not hugely supported, and ultimately it is an asset class that managed money does still speculate on. So that's the story with Brent as far as I'm concerned.
Do you think the news this week on Russia-Ukraine will impact Brent?
I mean, if we were to see a ceasefire and everything sort of renege and have ultimately Russian barrels coming back onto the market with no sanctions, then that would undeniably act as, a dramatic increase in legitimate supply in the Brent pool. Also you would see legitimate demand for Urals, which would pull demand away from implied Brent. So that would be very dramatic in terms of price action to the downside, which also suits Trump's sort of drill baby drill, low oil price narrative. So yeah, if we see a reconciliation on that side, then yes, Brent should come off. I would be skeptical. I wouldn't assume that Ukraine are going to automatically accept this round of Trump-led peace talks. So, it seems to be very favourable to the US, these peace talks.
And to Russia, I've seen one US senator call it a Russian wish list.
Yeah, quite. I think it's all hinging on the next 24, 48 hours. But we do appear, though, the overview is we appear to be close to something which has taken an awful long time to get to this point.
And
but
Trump's trying to force it through, though, isn't he?
Well, yeah, and presumably the chatter is that, he's done deals behind the scenes as well on things like rare earths and whatnot, which is,
And I'll be cynical to say it's exactly to help his ratings, which are currently pretty low.
Not too good,
falling.
as you took us through at the start of the show. Crypto crash, then let's go back to that.
Yep, crypto, it's down 24% in November already. That's the worst month since June 2022, third worst month this decade. People say it's a store of value. Well, it's down 24%. Ethereum's down well over 34%. Gold's only down 7.5%. Macro strategy, important one as well, worth mentioning, that's down 68%. But certainly Bitcoin is not a store of strategy.
Yeah, I think crypto got hit across the board, but particularly if you look at the headline standard, obviously Bitcoin, it took a hammering and broke through this supposed $88,888 lucky double eights in Asian cultures quite often. It broke through that key support very fast. So that really didn't provide that much of a bounce. And yeah, seeing the correlation between a lot of the NVIDIA style AI stocks, there has been a historic correlation between those. So it's the momentum, the wind is out of Bitcoin sales in that regard.
Yeah, from the chart, I see the next support at $77,000. But an interesting topic I'm seeing discussed now is that the crypto market should not focus on Bitcoin as the market leader anymore because it uses so much power. And of course, the need for power is now much more focused on AI stocks, whereas you don't have the same proof of work power demand for cryptos like Ethereum.
Now, we touched on possible movement, didn't we, a little earlier on by the US central bank. What about those thoughts on others cutting rates?
Yeah, we have the New Zealand central bank this week looking, the market's fully priced in 25 basis point cut there. The market's also looking for 25 from the Bank of England in December. But actually across the board, other than that, the market's basically saying we've seen the bottom in the cycle. Yeah, ECB, there's not a full, not even half a cut priced. After this cut in New Zealand, their RBA Canada, the market's saying that's pretty much the last cut of the cycle. Personally, I think you'll see more cuts because if the US economy slows down, that will impact the global economy. So I expect to see more cuts. I've mentioned before, inflation's a problem in the US, but in Europe, you're more likely to see disinflation and perhaps even deflation as China offloads its goods. So I'd expect to see more cuts priced in the Eurozone, which would push euro dollar down as well.
Right, let's take a look now at what key data and events are happening this week. What should we all be looking out for?
Yes, certainly. Data this week. Well, we've had German IFO already out today. Tuesday, we have US PPI and retail sales and ADP employment. On Wednesday, we have the big UK budget, US jobless claims, PCE inflation, which is the Fed's favoured inflation data, new home sales and Australian inflation. Thursday is a US holiday, Thanksgiving, and then Friday, Japanese CPI, employment and retail sales data. So it's going to be a quiet end of the week with the US out, but certainly plenty to keep an eye on.
Well, I think we'll all be having a lie down, quite frankly. Just before we go to James B, just remind everyone where they can go to get plenty more information about your fantastic courses.
Yep, as we mentioned before, we do internal training here that people can join, external candidates can join when our new traders join. We do external face-to-face training with our clients, courses, everything from commodities, financial markets, derivative trading, risk management. Chris Gooder, our Formula One head of performance psychologist, he's doing training on psychology of sales, peak performance, technical analysis, behavioral finance courses accredited by the Institute of Banking and Finance in Singapore. So we do these face-to-face with our clients. We also have some online training. So you can find that with this QR code that'll take you to our website.
What a brilliant offer. Fancy a refresher then, James T?
Yeah, definitely.
All right. And that is it for this week's Macro Mondays. Huge thanks, of course, to James Brodie and James Todd, and to you for watching. Remember, you can get lots more about what we do over at Flux.live and Freemium. See you next week.